Hello, this is Japanese Economic Review Channel. Today, we will analyze the Greater Tokyo new condominium market for March 2026. We are witnessing a critical juncture defined by decoupling, a sharp supply contraction paired with sustained high valuations. Let's explore the underlying data driving these diverging market dynamics. The market is experiencing a sudden break in demand alongside stubbornly high prices. Supply plummeted by 35.5% year-over-year, and the initial month contract rate sits at a sluggish 64.5%. However, average prices remain firmly above the 100 million yen plateau, with Tokyo proper commanding 57.5% of total supply. Looking at the specific numbers, total supply was just 1,425 units. The contract rate dropped a steep 11.7 points year-over-year. Despite this cooling, the average unit price is 104.13 million Japanese yen. Crucially, the price per square meter increased by 0.5% to 1.597 million Japanese yen, marking the 11th consecutive month of growth. This chart illustrates a significant momentum shift. After a recent peak of 71.7% in February, the contract rate has contracted sharply to 64.5%. This volatility shows absorption is falling below the traditional 70% benchmark that indicates robust market health. Buyers are becoming increasingly selective amidst soaring costs. Here we see the price paradox. How can average prices drop 0.7% while the per square meter price rises 0.5%? Developers are subtly shrinking floor plans to an average of 65.21 square meters to prevent total prices from skyrocketing further. This strategic compression mitigates sticker shock and maintains the 100 million Japanese yen environment. A clear geographic divergence is occurring. In central Tokyo's 23 wards, the contract rate is a sluggish 58.6% due to the 150.23 million Japanese yen average price. Conversely, Chiba boasts an 80.2% contract rate. Budget-conscious buyers are flocking to affordable peripheral stock, while luxury inventory moves at a much slower pace. The market average is heavily skewed by the, quote, central 6 feet wards. Though they provided only 107 units, their average price was an astronomical 182.83 million Japanese yen, or 2.914 million Japanese yen per square meter. This low-volume scarcity of ultra-luxury assets is a massive driving force behind overall regional valuations. Examining layout configurations, the market remains fundamentally anchored by the 3LDK family product. This category accounted for 881 units, or 61.8% of all new supply, achieving the highest structural liquidity. Despite shrinking overall footprints, securing 3 bedrooms remains an absolute priority for today's buyers. This inventory mapping highlights that the 104 million Japanese yen average is not a statistical anomaly. A massive volume of 449 units, over 31% of the new supply, was explicitly priced above 100 million yen. The market has structurally shifted, supported by a concentrated volume of ultra-luxury stock targeting high-net-worth demographics. Turning to high-rises, we see signs of deceleration. High-rise contract rates plunged from 93.9% last year to just 62.6% for the 356 units supplied this month. Meanwhile, total unsold inventory stands stable at 6,409 units. Notably, we had 0 same-day sellouts this month, indicating a pause in speculative buying. Looking ahead to April 2026, supply is forecasted at a highly constrained 1,000 units. Compared to the 2,426 units in April 2022, spring supply volumes have fundamentally reset to less than half. This deliberate volume restraint effectively caps potential inventory bloat despite cooling demand. In conclusion, the current market architecture is built on 3 pillars: volume restraint capping inventory, value retention through shrinking floor plans, and a stark geographic divergence between luxury Tokyo and affordable suburbs. Developers are prioritizing price stability over volume. Thank you for watching the Old Japanese Fairy Tales channel. We look forward to having you with us again.